Hi everyone, and welcome to our SaaS Academy webinar about SaaS Metrics. We are very thrilled to have you here today. My name is Doreen, and I'm the Technical Strategy Manager for Software Partners in Western Europe. I joined Microsoft 4 years ago, and I'm helping software partners transform their business and expand their market share. I also have a developer background, which helps a lot in a biz tech discussions that are an integral part in any SaaS transformation journey. Today, I have the privilege of hosting the session together with my colleague Elias.
Hello everybody, very glad to be here. My name is Elias Standell and I am a partner development manager working out of Microsoft Norway. I've been in Microsoft for the past 6.5 years, and I've actually focused all of my time in Microsoft working towards software as a service companies or independent software vendors, as we call them. I'm really looking forward to the workshop or the webinar today, and I think we should get stuck in. So a small disclaimer before we start our webinar is that me and Doreen, we are not necessarily SaaS experts, but we have been working with some of the top ISVs in Europe. And during this session, we will be sharing our insight and knowledge and experience working with these companies. Doreen, why don't you start by telling us the difference between traditional models and SaaS?
With pleasure, Elias. To set the scene, I want to spend a couple of minutes understanding what is a SaaS model. It's a recurring revenue business model, and you have a few ways of earning it: monthly, annually, and if you sell it to a big B2B customers, you can also sell it as a few years contract. Your company should track ARR to measure overall growth and how much revenue you can expect in a year. It is also common to examine ARR of a company to measure its size. And while ARR measures the value of recurring revenue at a single point in time, the average contract value normalizes that revenue across 1 or more years. In the early stage of acceleration, it's important to remember that acquiring additional customers quickly results in squeezed profitability. It's because the cost of acquiring each new customer is higher than the revenue from that same customer, which is recurring and therefore not upfront. On the other hand, selling to new customers is much easier, as the SaaS is repeatable rather than tailored, and also because geo expansion and human capacity limitations are no longer a blocker for growth. SaaS model is different than traditional business because of the importance of customers' option to churn and the need to keep the cost of acquisition as low as possible at all times. And also because keeping the customer satisfied is always on. This is unlike traditional business that the option to churn is just at a contract renewal. Elias, from your conversation with some of the ISVs in Norway and Western Europe, what can you tell us of their consideration while transforming to SaaS?
Yeah, I can, Doreen. I think you're touching up on some very relevant topics here that we will touch upon going through this webinar. And just from this slide alone, a lot of these things are areas of consideration for ISVs when they're going towards SaaS. And I can only mention a couple of examples, but one thing is that in the old days we used to develop software in a totally different way, and we basically gave the customer the software on discs or CDs, and that was the responsibility of the customer. Now these days we are managing and operating, that's the keyword, operating the software at all times, which means a whole lot bigger responsibility, but at the same time, I would say an opportunity for SaaS companies to really thrive with their customers. So, adding that customer success unit and really staying successful with your customers is super important. So let's continue with the webinar. I'm sure we have a lot of exciting stuff to go through.
Yes, that sounds like a good deal. Let's start by looking at what it takes to run a SaaS business successfully. And I want to point at the 3 things that matter most: acquire customers, because SaaS business model is all about expanding your market share and quickly. Retain customers, but it's not enough to acquire them. In a SaaS business model, the most important thing is to keep them happy. And number 3 is to monetize customers and ideally encourage them to expand their service and hence spending more money on your additional services. So considering your investment is growing as you acquire new customer, the second item of return customers should really be your top of mind if you are transforming to SaaS. If you can't keep customers happy to use your service long-term, why bother acquiring new ones? Our customers also agree that a SaaS business model is more complex to build. Now that we understand what's important when you run a SaaS business, let's look at the key variables that makes the difference to success. These are the topics that Elias and I will cover today, so take a look before we dive in. Elias, please kick off the first element of how to move from legacy model to land and expand model.
Yes, with pleasure, Doreen. So some of you may have seen this slide before, but I'll explain it because it's really good, or at least seen the model. So what we do have here is what we call the layer principle, and it's basically going from a legacy model and then over to a land and expand model. So this is how we used to do things in the old times, which I was referring to earlier. So we developed something, we took it to market, we sold it, installed it, supported it, and all of these, blue bubbles that you see here were transactions that we could basically monetize. And then there was a new version of the software where we took to market, sold and installed, supported. And this is basically the land and renew cycle. So we landed a sale, we came back 36 months later, and we then tried to renew that sale. We didn't know how much success the customer was having with the product, but we were, giving them a good deal, selling the software that way. So basically maximizing your profit always comes back to taking advantage of the new business models to land and then expand. So what is different with the consumption business model? We're still developing it, we're still taking it to market and selling it, but we're not maybe making any real money before we install it and the customer is starting to use the product. And that's sort of the difference between these two models, is that as the customer is adopting, and we need to understand how they are adopting the software, and then when we understand the different areas where they might have success, we can expand in those areas and then make more money basically than what we would have done in the legacy model. So you can see here is pictured as sort of a tree where you could then branch out in different areas of the software, and you break these things up into microtransactions instead of having a few big transactions. And this is really one of the exciting areas of consumption business models. So it's really cool. And Doreen, why don't you take us through the SaaS P&L and cash flow, because it's also very interesting.
Absolutely. So SaaS business faces significant losses in the early years, and it's often associated to cash flow. This is due to the heavy investment upfront to acquire the new customers while recovering the profits from that investment over a long period of time. The faster the business decides to grow, the worse the losses become. And many investors challenge to understand this. When they see the losses growing from acquiring new customers, they want to hit the brakes at the exact moment they should hit the accelerator. If they hit the accelerator, it means that they will need to add more investments to cover the cost of acquisition for lead generation, hiring additional sales reps, or adding data centers capacity, for example. And to illustrate this, imagine it takes 5K to acquire the customer that will be paying $500 a month. It will take 5 months to realize the investment. So often it might present a cash flow issues for the company. Now imagine that business will do well and grow fast. It will mean that the cash flow gets deeper as that business increases the growth rate of acquiring new customers. The break-even point is when there is enough recurring revenue from the customer install base to cover the investment needed for new customers. This is the point when SaaS business is turning into profitable. And it's important to remember that managing and communicating around this cycle of growth is a permanent part of the landscape for any SaaS company. And since the SaaS business is usually a winner takes it all, once succeeded, you should invest aggressively to grab market share as fast as possible. You want to do that to position yourself as a winner in your space. Elias, take us through the next illustration of what I have described.
Yes, we'll do it with pleasure. So what's really the impact of growing faster as a SaaS company? So as you onboard more customers, your cash flow trough, it gets deeper. And for those of you who don't know, according to Investopedia, a trough in economic terms, that can refer to a stage in the business cycle where activity is bottoming or where prices are bottoming before a rise. So the important thing here is that you need to be prepared for this, and you need to make sure to communicate this to your leadership, owners, or other stakeholders that could be frustrated with what they see. So the timing that we've used in this slide is not fixed, but it could be around 30 to 40 months before you really start to see that uptake. So over time, you see that larger uptake, but as you are acquiring more and more customer, your cash flow will take a bigger hit. So be advised again that this is an illustration. Your cash flow, it might look better if your customers are paying a lump sum annually versus a monthly recurring cost, which is what Doreen referred to early in the presentation. And that's by having the customers pay a bigger sum annually, it might be more normal for you as a company if you're doing maybe more enterprise type of sales. So talking then about cost to acquire a customer, I think Doreen will help us understand what you should study and measure.
Absolutely. Critical is the unit economics because it's ensuring your LTV must exceed the CAC. This is essential to having a viable SaaS business. Because of the losses in the early days from acquiring new customers, it is difficult for management to figure out whatever the business is financially viable. The unit economics of each customer you have can help you answer that. And you need to be familiar with these two metrics. LTV is the lifetime value of a typical customer, and CAC is the cost of acquiring a typical customer. There are several elements that influence the unit economics, and it's surprising how many companies underestimate it. It's therefore very important that you examine each component of these metrics to understand what you could pull to drive overall improvement. Let me give you an example. You could make a cost of acquisition process more efficient or cheaper, or you can also improve the product for achieving higher lifetime value. Usually companies are over-optimistic about the cost of acquiring a customer, and they think it's enough that the customer would be thrilled from their products. In reality, the acquisition process, as well as the complexity of sales, are often different than anticipated. So how do you quickly know if your SaaS business is viable? Here are some examples based on studies. If your lifetime value of a typical customer is more than 3 times higher than the cost to acquire them, then you will be profitable in the long run. Improving the lifetime value influences churn and can minimize it. And respectfully, if you improve in a way that you are managing to keep more customers from churning, you become more profitable. The second check is all about profitability and cash flow. You can predict the time to be profitable by checking if the months you use to recover the cost of acquisition is shorter than 12 months. As an indication, many successful SaaS companies can recover their cost of acquisition in 5 to 7 months. So let's see how CAC is connected to hitting the accelerator, leads generation, and segmentation focus. It's the CEO job to decide when to hit the accelerator, without a doubt. To recap, that means negative influence on cash flow due to the cost of acquisition. So once you know your business is viable, hit the accelerator pedal, but be also prepared to raise the cash flow needed to fund this growth. A SaaS business that is in a good shape can hit the accelerator. Otherwise, your business needs to investigate what do you need to improve before you consider expansion. You should also evaluate different lead sources as they each have different costs associated to them. So your decision is to evaluate which one makes more financial sense. A good thumb rule is to gain your customer acquisition cost within 12 months of recurring revenue. If you achieve that in less, you can spend more money on marketing and sales. Last is the power of segmentation, because companies often test their offerings with different types of customers, pricing model, or even industry verticals. You should focus on the segment that show the quickest return, determine the most profitable to pursue. And Elias, can you please guide us through how Microsoft can add value in the context of these SaaS guidelines?
Yes, sure. I've had a lot of experience working with the Microsoft partners, taking advantage of all the different programs that we have, so I'll be happy to. So let's start by showing you 4 simple points for you to think about in how Microsoft adds value in the context of SaaS guidelines. So number 1 is our marketplace storefronts. They target both the business buyers through our platform AppSource and technical buyers through Azure Marketplace. And combined, these two have over 4 million active users monthly. And you could utilize that power to generate leads more effectively and close business through our marketplace platform. So that's leads generation. Number 2 is customer acquisition cost. If you get yourself in a position where customers want to purchase your application from our marketplace, and that customer happens to have an Azure consumption commitment to Microsoft, that's a sort of an Azure agreement style, that customer can effectively acquire your solution using its existing Azure commitment, and your application is running on Azure anyway, so why should it matter? And this could help lower your customer acquisition cost, just utilizing our marketplace storefront. We have something called the Azure IP co-sell program, which is essentially that we in Microsoft incentivize our sellers to co-sell solutions that are running on top of Azure. And this Azure IP co-sell program shows that when Microsoft and the SaaS provider, you, collaborates on closing a customer deal, the deal closes faster and it closes with more value. So it's really bringing the best of 2 customer teams and really helping you be more profitable and increase your average revenue per account. So that's the 3rd tip. Collaborate with your Microsoft sales people locally and become Azure IP co-sell ready. And number 4 is around how we can potentially help churn. So as we in Microsoft, we have, I don't know, several hundreds of thousands of customers worldwide. Some of those customers, they will be larger and more important. And these customers, they tend to have their own customer account team and customer success unit working on them. So if you happen to have co-sold your solution to any of these major customers, as referred to in point number 3, they will also be incentivized on helping you to stay successful with these customers. Because remember, your solution is running on Azure and the Azure usage is very important to the customer team. So take advantage of that, co-sell to Microsoft, work with those customer teams, and we could potentially help you with several of these metrics. So now I think we should take a little bit of a closer look at other elements that could contribute to annual recurring revenue.
Yes, so let's continue the journey. There are 3 elements that contribute to annual recurring revenue. The first one is the new. These are the new customers added during the year. Number 2 is the churn. These are the customers that cancel their subscription, so they consider the loss of revenue. And the last one is the expanded, and these are existing customers who expand their subscription because you keep them happy, and they represent a higher revenue stream. So in a small calculation, your net new annual recurring revenue will be then the sum of the new and expanded customers minus the churned one, the ones you lost. This exercise is one of the most important exercises to help you understand and run your SaaS business. Pricing is also influencing the ARR. So Elias will take us now through the elements that can help select the right pricing model.
Yes, let's do that. So pricing is something that just continuously coming back to us in discussing with, especially when we get into deeper discussions and partnerships with the SaaS companies. Pricing is always something that they need help with. That's why we also have addressed that issue or opportunity and rather held some workshops together with these companies over the years. So now let's touch upon the importance of pricing. So if you get it wrong, customers will probably select other vendors with similar value props, or they could even churn in the long run, or maybe worse than that, you could leave money on the table subscribing or customers subscribing to your solution year after year, and you're just burning money every month you go. So, but if you get it right, you could maximize that profit. And this, if you think about it, there's really no other way in which you could increase revenue with one click by, for example, 20%. It's really magical. So let's go quickly through this six-step decision framework. So number one, what value does the customer gain from using your product? So ask yourself, what is the real value of my product, and be able to articulate that through your value proposition. So number two, is the customer aware of this value at all? So ask yourself, does the customer perceive the value? And if they don't perceive the value, you should probably go with a freemium model or a low introductory price so that they can test the product and then really see the value. But if they do really see the value, then you could reset that price ceiling even higher and just adjust for the increased interest in your product. Number three, can the customer base be segmented? So really look for opportunities to segment the customer base to see if there are different values that can be separated from each other. Are there, for example, different customer types, public sector, private sector, or other ways that you could segment? Look for opportunities to do that, and you could maybe derive more value from your customers. Number four, is the customer's demand variable or uncertain? So what kind of customer type do you work with? Dynamic pricing, it provides options to respond to customer demand, and understanding your customers' usage trends, that can help you determine whether to deliver a consumption-based or a tier-based pricing, which we see a lot of ISVs use. So number five, establish a floor price. So you need to calculate a price floor. So look at your customer acquisition cost, see how long it takes you to pay for the money that it took you to gain that customer, ref what Doreen was talking about in the previous slide. And the purpose of this exercise is to determine if your business essentially is economically viable. So number six, what value metrics are most important to the customer? So with any of these pricing strategies, as the customer is growing with you, what metrics will increase the most? Is it the gigabytes? Is it the number of seats? Is there other things that will grow? So find out what value metrics and really, study this topic. Value metrics is important, and see what will increase the most. Yes, we also had some pricing sessions in this series of webinars, which you should register for or see the recording in afterwards if you haven't done that already. We also have something coming up around value proposition design, which is awesome. You should check out those recordings as well. But now, Doreen, let's talk about product and marketing metrics.
Thank you, Elias. Yes. So during our presentation, we have covered many of the financial metrics of a SaaS business, but there are also product and marketing metrics that you should be aware of. For example, Under product metric, you will find the Net Promoter Score. This metric measures the willingness of existing customers to recommend your company to other people and build brand awareness. Your brand includes customer reviews, social media posts, and brand mentions around the web. And companies may even have a dedicated team in charge of keeping their online reputation in check, being aware that one public slip can put their entire brand at risk. Another example under marketing metrics is the CTR, click-through rate. This metric is showing the ratio between impressions and clicks on the actual links. And there are also social media KPIs, amount of likes, shares, exposure on LinkedIn or Twitter. And some of those marketing KPIs improvements are directly linked to the technology you use. For example, bounce rate, which is the percentage of website visitors who abandoned your site within a few seconds, and this metric is directly linked to how fast or slow the web page is loading. If your product is in e-commerce, you will be surprised how much revenue is lost if the system is not fast enough. One more example is SERP, rankings, which is your position in the search engine used by customers. This ranking is directly correlated to how fast your page is loading. It's important to identify where your biggest paying target audience is, and when you are successful with that, you gain the highest ROE for your marketing investment, as it can reduce your cost of acquisition and there positively influence churn. We said it a couple of times in this presentation that churn is very important. Let's explain why. In your early SaaS business days, churn matters a lot less to your business. Quick example, losing 3% of your 100 customer base means that 3 customers churned and you need to find 3 new ones. But what if your customer base is 100,000 customers? Where would you find 30,000 new customers? When reporting churn, typically the impact of them is blended into a monthly number. A 2% churn, for example, means you have a very sticky product with strong product market fit and significant investment directed at reducing involuntary churn. 5% is roughly where you can expect to start. 10% churn is evidence of a very poor product market fit and existing threat to the survival of your SaaS business, so pay attention to that. An interesting element you won't naturally expect to influence churn positively is a price increase. It's because a higher price preferentially select for better customers. So in fact, increasing prices is more effective than entrepreneurs expect it to be and may change the mix of customers who buy your product. This factor leads many low-tech SaaS business to march upmarket over time. We have a nice illustration of the impact of churn, and I'll let Elias guide us through this.
Yes, we have a nice picture indeed. So as a SaaS company becomes larger, the size of the subscription base becomes large enough that any kind of churn against that base becomes a large number. And that loss of revenue, it just will require more and more bookings coming from new customers just to replace the churn. So as a result, your growth, it slows substantially, but there might be a solution, and it's called negative churn. So if we jump to the next slide. One slide back and we'll yes, there we go. So negative churn. So just to help illustrate the power of negative churn, take a look at the 2 graphs that we have above. It is with cohorts behaving with 3% churn and then with 3% negative churn. And for the sake of it, just let me explain what a cohort means. A cohort is simply just another word for a group of customers. And in the SaaS world, it's typically used to describe a group that joined in a particular month. So there would be a January cohort, February cohort, etc. And that's what you see in the different colors above. So in our graph, a different color is used for each month's cohort, and you can see in the pictures how they are declining or growing based on the churn rate. So in the left graph, we are actually losing 3% of our revenue every month. And you could see with a constant booking rate of $6,000 per month, the revenue reaches 140K after 40 months. And the growth is just really flattening out. The right graph, we may be losing some customers, but the important thing here is that the remaining customers are more than making up for it with increased revenue. So with a negative churn rate of 3%, we reach 450K in revenue, more than 3 times as much. And the growth in revenues, it's just increasing, it's not flattening. And that is exactly why investors are drooling after SaaS businesses with negative churn. So then you might want to have a couple of tips on how to reduce your churn. So number one, call your customers, add a dedicated customer success team, as mentioned before, make your customers be successful with the software and call them, talk to them. Number two, measure your customer engagement. So make the metrics the top priority of that customer success team, have them measure it, have them live by those metrics and really, measure it and how they engage with your software. Number three, figure out what features that make your product sticky. And once you've figured out what makes it sticky, you can drive sales, support, and success units towards those services. And number four, allocate your best reps of saving customers that call to cancel, because we know that churn kills a SaaS business. Number five, consider testing a longer term contract, because binding customers for a longer period of time is seldomly a bad thing financially, and your CFO will be very happy. And number six, look for other factors that correlate to churn. Could it be places where you are not looking? So these are 6 steps that you might want to take into consideration. So I think, the art of making money while you sleep, that's the ultimate dream to most, and especially if you're a SaaS founder. And we believe that art can come into life in a partnership with Microsoft. So Doreen, take us through the wrap up.
With pleasure, Elias. Just before we do that, I think all the tips that you have mentioned here are valid also for a traditional business. I mean, the only challenge in a SaaS business is that they can churn more easy. I mean, keeping the customer happy, calling them, engaging them, that goes without saying. But in a SaaS business, it could be a threat to the existence and the profitability, for sure.
Yeah, for sure. Especially if you're in a monthly contract instead of an annual contract. But I definitely agree with you.
Absolutely. So, ladies and gentlemen, this was our session about SaaS Metrics, and we hope you enjoyed it and found it useful. These are the topics that we have covered, so you can take another quick look at them. And we are both hoping that you will be leveraging what you learned here to start your SaaS journey today. Thank you very much, everyone.
Thank you.
Thank you, Elias, as well.